But enough of my technical mumbo-jumbo. Allow me to demonstrate.
We're talking technicals on Money Life, and we will demonstrate that it's not all technical mumbo-jumbo. Today, we're going to be having that discussion with Michelle Schneider. Mish Schneider is the Director of Trading Education and Research at MarketGauge.com. Just like it sounds, MarketGauge.com. Mish Schneider, it's great to have you back on Money Life.
Nice to be back, Chuck.
This has been a challenging market because, well, we had been range bound for so long. We got out of the range just when everybody was starting to think, oh, maybe this will be good. We wound up going back and testing support levels and having a drop off. And then we got a little bit of good news, or maybe perceived good news, out of Jerome Powell last week. And the market seems to want to go up again. So to you, are we back into range bound and just cycling between support and resistance? Or are we closer to a breakout one way or the other?
First of all, it is August, so we cannot discount that people are away. Certainly the last week of August, I think it's going to get even slower as the week progresses until we all come back from Labor Day. And that has an impact on the market because the volume has been way down and can also increase volatility, as we have seen. However, looking forward, I think there's two really big spots we have to watch, Chuck. One would be the small caps, which almost took out tremendous resistance where the SPYs and the Qs made new 52-week highs. It was not the case with the IWM or the small caps. And so we're really watching that carefully, I think, for what's going to happen next. Within the small caps, of course, we have commercial real estate, and we've had a lot of negative headlines there. So that's where bonds and higher bonds have felt an impact. But at the same time, we also have a lot of manufacturing stocks with good earnings, and that's the good news. So that's kind of what we're watching. If we're looking just at a chart of IWM, if we can get back over this 190 level, I think that would be incredibly optimistic, and we may even see it outperform the growth stocks. On the flip side, considering it's just sort of bouncing off of the major support at 180 and not really showing any great muscle at this point, a breakdown, and I think drags the whole market down, and we'll see another, possible several hundred points in the S&P, maybe even back down to around 4,200 or 4,000. And that's where we're at. We're sitting, dancing right on the middle in terms of equities.
Do you have a feeling, like, is there a more likely scenario to you? Is there something that you are looking for that you then have to see play out? Normally when I'm talking to a technical analyst, they're saying, I'm waiting for a confirmation, or I'm waiting for a couple of days that show this. But what's your sense right now?
Well, my sense is if somebody had to put a gun to me and say which way, I would say based on some of the weaker areas, it certainly looks more negative than positive. However, my actual sense of what the market is doing, I still see a good potential chance for rotation more into the small caps and out of the growth as we're going into the end of 2023 and into 2024. Overall, if we're looking at the biggest bubble around the market, we're still looking at inflation as a bubble. We're looking at inflation, though, through different means. It's not going to be used car sale prices or the housing market, which, of course, is a completely complicated situation, nothing like what it used to be. But we're looking at it through wages. And I still believe that the trend towards higher wages as we're seeing potential strikes with UAW coming up, and even though we've averted strikes with airlines, et cetera, the growing theme in this country has been we need more money. And so it's going to be, I don't have a strong feeling right now, except in commodities. Certain commodities I still feel very bullish on.
Okay, well, what are those commodities?
Let's start with the kingpin, gold. People have talked a lot about gold, and what's interesting is that for a long time, people said, Bitcoin is going to supersede the gold market. And of course, Bitcoin has been really basically flatlining, very boring, actually, waiting for ETF approvals, and we see what happens there. But gold has really held rock solid at 1,900 an ounce. And now, if you're looking at the December contract, flirting with 1,950, which means it's just a hairpin away from taking out 2,000 and maybe going much higher. So what does that mean? Probably not great for the stock market. because people tend to flock to gold for safety, and also an indication that possibly BRICS is getting a bigger toehold in the market in terms of threats to the dollar. And also we have other agriculturals still sky high right now with sugar and soybeans, cotton, cocoa, all of these commodities with reduced exports from the countries that produce them because of weather problems. So all of this is circling, as I said, a huge bubble around the market.
I'm curious because, of course, you are tracking commodities and always have been. You know, we've seen a lot of things going on. We would expect war in Ukraine, for example, to affect commodities markets, and it has, but maybe less than expected. But all the things that we're seeing that are being attributed to climate change, all of here we've got fires here, and we've got this and that there. How much is that wreaking any havoc with the commodities market? I mean, does it change the way? I mean, obviously, in any situation, we're worrying about, you know, the unknowns and what have you, but it seems like every commodities market has been in some measure of, you know, panic mode every now and again. Is that more than in the past, or is it just our sense because of headlines?
Well, that's a great question. First of all, let's talk about the Ukraine. They have been allowing a certain amount of grains to go through. And so I think that's one of the reasons why the wheat market has relaxed a lot. However, you know, the weather, it's not just what's happened over the last summer of incredible heat and drought, but now we're entering, you know, obviously storm season can be disruptive. And then what's going to happen in the winter, you know, if we get any kind of real frigid situation, and we can still have a dry winter and be extremely cold, we don't know. What we do know that the weather has been predictably unpredictable in that nobody's really shocked that we're seeing these tremendous weather patterns. And, you know, we don't have to go into the reasons why. It just is what it is. But there are some things that have happened as a result. Panama Canal, for example, has still such persistent drought that it's been taking ships way longer to get through. And, you know, we've managed to get bypass with the fires in Canada in terms of supply chain, but that looked threatened for a while. It does seem like we're dodging bullets in the commodities market, but that's why there's two things besides gold and silver to focus on, which could be really basically telling us something else far more insidious is under the hood. And that also, of course, is the oil and energy market, which has been an outperformer this year. And even now with talks of China having less demand because their economy is slowing, we're still seeing oil at $79, $80 a barrel, not at 2022 peak, obviously, but still another factor to be keeping an eye on as we're going forward. So that's why I'm very focused on commodities still until I absolutely am sure that supply is not an issue, you know, including copper and lithium. I mean, all of these raw materials are in short supply, and that could be a problem, especially if demand increases.
I'm curious because here we are talking commodities, et cetera, something that has been traded wildly in a lot of different ways that I get lots of opinions on, and not just from the traditional guys, but also from the traders, has been cryptocurrency. And of course, crypto has been widely whipsawed in these economic conditions. What's your take on trading crypto right now?
Well, right now it's been frustrating whether you're a bull or a bear, right? So I think the more recent decline that we had sitting here very much on support probably means to me that if we get any more selling coming in, it might actually start to be somewhat of a buy opportunity. The SEC has been a player in this in terms of which ETFs that are cryptocurrency related are going to be approved. So we may actually, even as soon as next week, have more of an idea whether we're going to see another trip down or possibly go higher. But overall, in general, since Bitcoin seems to be the granddaddy for all of the other cryptocurrencies, I think that I wouldn't touch it now, but I would be very much interested to see what happens even in the next week or so. If we hold around this 24, if we can get back up over, let's say, 27, 28, I might look for a pop back up to 30, but I'm not going to say, oh, we're going to see, you know, 50,000 in crypto anytime soon.
Let me ask another question, and this is a trading education question. I have dealt with traders who say trading is trading. I can trade anything. Tell me what it is. Let me know what the playing field is. And within a few seconds, I can be trading anything. Does that hold? I mean, when we're talking about crypto, here you are looking at commodities, right? And talking about the importance. And I think a lot of people can get their head around it where they can't necessarily get their head around crypto. But is trading just trading? Like we just have to put in the parameters and you look at the trades? Or is it easier or harder to trade commodities versus crypto versus stocks, et cetera?
Another great question. In essence, in the purest form, as a technical trader, one would have to say trading is trading. If things are technical, which, by the way, cryptocurrencies are incredibly technical, then if you know how to read a chart and you understand momentum and price and you have a sense of risk and reward, then you should be able to plot anything in there and trade it. However, there is such an thing about volatility where certain instruments, whether they be commodities or cryptocurrencies or even certain equities, are just more volatile than others. And so it does behoove a person to say, I can trade anything. However, it probably makes the most sense to study the volatility or, in essence, the personality of that particular instrument before you just jump in. And here's a classic example. I mean, obviously, if you're going to trade, let's say, SPY as an index, and you know that SPY trades roughly about $5 a day. That's its average range. That gives you an idea of what the volatility or the personality of that particular instrument is. However, if you want to trade something like GLD, gold, that trades only about $1 a day, then again, you have to adjust your trading strategy based on the much lower volatility of an instrument like gold because of its average range. And I'd say that's the only other thing to add is know what it is you're getting involved with. And then, of course, use the technical analysis as you would in any case, whatever your favorite indicators happen to be.
Mish, we appreciate everything that we learn about technical analysis from you. Thanks so much for joining me again on the show. We'll talk to you again down the line.
Thank you so much, Chuck.
That's Mish Schneider. Michelle Schneider is Director of Trading, Education, and Research at MarketGauge. MarketGauge.com for more information. And by the way, she's on Twitter at MarketMinute. And we are just getting...